about. So I thought I should just do a little bit of a preamble about who Fabulous Networking are, and then introduce Mike and hand over to you, Mike. So for those of you who don't know, Fabulous Networking is a business networking community that likes to offer a little bit more than just business networking meetings, and to support our members and their families, both in life and in business. And so we thought this month we would focus a bit on finance and ask a couple of our members to do some presentations and Q&As to help us all through these tricky times and through our normal financial planning. So today I am delighted to welcome Mike Black of it is Woodhams, isn't it?
Oakwood.
Oakwood. Why have I got Woodhams in my head? I knew when I said it was wrong.
They've both got wood in them.
They have, yes, absolutely. So Mike of Oakwood, who is an experienced financial advisor, part of a team.
That's their code for old.
No, it's not. You're younger than me, so that makes it young.
Yes, but I don't look it.
You're the father of twins, I believe, Mike.
I am, yes.
And a singer in a band.
Yes.
So far more than just the financial advisor. And I'm just going to hand it over to you, Mike. There's going to be an opportunity for people to ask questions. If you want to ask questions whilst Mike is presenting, pop them in the chat. We can read them, or I'll open up the airwaves when Mike has finished. So we're here until about 5-ish, or until we've done, whichever's soonest. Okay, Mike.
Brilliant.
Over to you.
Thanks, Glenda. Yes, I'm. As you say, I fulfil those 3 roles that you've mentioned. The only one that I'm actually qualified to do is the financial advice. Certainly lacking in qualifications in both other categories there, but there we are. So I can see we've got 1, 2, 3, 4, 5 other people on the call, but I can't see any of their faces, which is probably good news. when they dissolve into looks of horror and things I'm going to say. But we've got an hour, I think, set aside for this. Rest assured, I have no intention of talking at you for an hour, and in fact, no intention of talking at you at all, really. So if you've got questions at any time, just come up. Let's make it as interactive as possible. I've done kind of question and answer sessions at various Fabulous Networking meetings, and I always have a little preamble, which is that I have a friend who's a very experienced accountant, director of many financial director of many companies, and we were having a conversation over a couple of pints one evening, and very sadly it turned to pensions, and I just said to him, well, obviously you'll be claiming your high rate tax relief through your self-assessment tax return, and he looked at me as if I'd started talking gobbledygook to him. So even somebody who's a chartered accountant and has run the finances for various companies over many years is not necessarily au fait with what I would regard as the basics of financial planning. So there really aren't any silly questions. The only silly thing you can do is have a question and not have asked it by the end of this meeting. Please do take the opportunity to ask whatever's on your mind. And in the meantime, I've got a little slide presentation that I just want to sort of show you and talk you through the basics of finances, hopefully throughout people's lives, and just sort of touch on a few things as we go through. And as I say, just feel free to interrupt with any questions. Don't feel you've got to sit there muted. I'd much rather talk about the things that you really want to talk about rather than anything that I've pre-prepared and might just be completely irrelevant or too low level or too high level or whatever. So I'm going to try and share my screen now. Bear with me a second. There we go. So I've called this little presentation A Sound Financial Life. And there's very little new in financial services. I haven't tried to reinvent the wheel in any way, just basically to give you a sort of bit of a grounding in finances. So there's our sort of subject for the day. He's an 18-year-old. As you can see, he starts his financial life on an income of about 18,000, something like that, which is the green line that you can see there. And he's going to work, very sadly, till he's 68 in this particular example. And his finishing income is going to be about sort of £85,000, something like that. So it's a fairly lengthy career. It's getting longer all the time because state pension age is increasing for the young amongst us, and you know, he's got to work a long time if he's going to work till state retirement age. But that, of course, is not compulsory. So what I want to talk about is kind of some of the things that might happen to him along the way. So first of all, he, she, and in fact, as parents, we want him to get out of the family home at some point. So I put a little home purchase, first home, at about the age of 26. In fact, that's probably quite early these days. I think the average first-time buyer now is around 36, actually. But this chap's had some financial advice, so he's kind of ahead of the game. So there are a few things that are needed for that. First of all, he needs to have a deposit if he's going to buy a home with mortgage, because lenders don't these days lend 100% of the value of the property, as they did back in 1987 when I bought my first property. So he's going to have saved up a deposit. And you can see I've got a line across the graph there that follows below the curve of his income, a dotted blue line, and in between the income and that line is the word savings. So at all stages, he's going to need to save some money. So the first thing he's going to be saving for is that deposit. And I've said it might take him about 8 years to save up the deposit to buy a property. Now, he might get some help from his parents if they're desperate to get rid of him, or he might have a gift, or he might get an inheritance or something like that. But in essence, he's got to have some money behind him before he's going to be able to buy this property. When he buys the property, he can do a couple of things. He can go along to the bank that he's been banking with for the last 8 years since he got his first job and his first salary, and they will offer him the best mortgage that's available from their range. Or he can go and see a mortgage broker, such as the ones that work in my firm and other firms, my colleagues who are very experienced mortgage brokers, and they will be able to provide him with a much wider choice of mortgage products, and also advise him on the pros and cons of the different options available to him. What they'll also talk to him about at that point in time is things like life assurance and critical illness cover and income protection, because the thing that pays his mortgage and earns his money and enables him to put his money away for savings and the future is his income. And if he can't work because he's ill, there are ways to stop that having a massive impact on his financial life. But only if you know about them and you've been advised about them and you take them out. So if you don't know about any of these things, it's unlikely that you're going to have woken up in the morning and think, I must get some life assurance, or I must get some critical illness cover. They're a mystery to a lot of people because they haven't been advised about them. So that's him, and he's got his first property with a deposit that he saved, and he's moved out of his home, and his parents have finished having the party. He's then decided that he's going to get married. Well, he probably didn't decide it on his own. He's going to get married, or he's going to have a civil partnership, or he's going to cohabit. In essence, he's found the one person he really wants to spend the rest of his life annoying. And he's going to set up home with that person in his first home. And at that point in time, it probably doesn't change the financials much, other than there's a bit more income coming into the property, so he might be able to save a bit more. He had his mortgage, he was supporting himself, so somebody else moving into the property and contributing to the bills is probably a good thing in terms of finance. So he probably doesn't need to worry too much more about things at that point in time. However, when two people get together, things happen, and they may have a child. And at that point, things get really serious. And if you're a very, very sad financial advisor like me, you start some additional life cover at the point where your wife comes off the pill. Not to put too fine a point on it, because from that point onwards, you could be bringing a new life into the world, and responsibilities entail. So they're having a child. So if he dies and he's got life cover on his mortgage, the mortgage will be paid off. They will have a home to live in, but they won't have any income coming in. So he might need a bit more cover at that point in time. So it's a time to review protection, as we call it. Different kind of protection from the one that would stop them having the baby in the first place. So he's then in this situation where there might be a drop in income. There'll certainly be some maternity leave involved, which they've got to plan for. So again, it's very important that those savings that I've highlighted there continue through that period of time, to give them a buffer, to give them an emergency fund, to give them some money that's behind them in those sorts of situations. And they were so enamored with the first child that they had another, or in the case of my family, that we had two at the same time. And that can certainly disrupt your whole life, never mind your finances. So there are a lot of things to consider in those circumstances, and it is very likely with 2 or even 3 children that they potentially have got to survive on one income. So they really have got to budget well in those circumstances. Although they potentially will get some help from the government in terms of child benefit and things like that as well. But it's rapidly become clear to them that the first home, the starter home that they were in, is not big enough. So they need to move on. So again, they've got the need to look at the mortgage market, and also potentially they're moving into a more expensive area than they were before, because when they first bought their home, they didn't need to worry about where their kids were going to school because they didn't have any. Now they have, and they do, and that's a very important consideration. And it means that prices near good schools are up. And if you want to be in that area, you've got to find yourself a bigger mortgage and spend more money on the property. So that's an important consideration as well. Now, there's a pretty big gap between them moving into that next home and the kids going off to university. But as I've experienced, and I'm sure Glenda has experienced as well, it does fly by. So my twins, who I remember very well when they were very, very small, have of course become much bigger. One of them about 4 inches bigger than me. So they're 23 now, and one of them's in his final year of 4 at university, and the other one has graduated, done a ski season, and is now in another room in the house looking for a job. So they do grow up pretty quickly. So but they go off to university, and then you've got things like rent and food and all the stuff that isn't covered out of the loan arrangements that they have to support them with and through, depending on how many kids you have and what sort of stage. That can go on for 5, 6, 7 years, 8 years, 10 years, who knows? So there's a lot of things to consider there. And again, it's another reason why it's so important to have this buffer that's been built up through your savings as you've worked your way through life, to have things put aside. And then eventually they come back from university, And then they realise that actually, as they've been away to university and looking after themselves for a while, being stuck at home with mum and dad is not the ideal scenario. So eventually they move, and you become empty nesters. But of course, a lot of that has probably involved you in some expense, potentially even helping them out as the bank of mum and dad with help with deposits for the properties they've moved into. So again, there's another draw on that savings that you've built up over that period of time. So all of those things have happened, and then suddenly you've reached retirement age. Oh, there it is. So you've reached retirement age, and your income, which in this example was up there at £85,000, suddenly drops dramatically. In fact, in this example, it goes right down to the state pension. And that state pension is at maximum level about £175 a week. That's 9,140 odd a year. And that is what the state will provide for you. Now, as you can see from the screen there, hopefully we will have something else on top of that. So first of all, potentially workplace pension, which is now compulsory for every employer who's got eligible employees, have to provide a workplace pension. And my advice to anybody who's got access to a workplace pension is be in it, because you make a contribution of 5% of your salary, of which 1% is tax relief. So the net effect is 4% to you. And for that 4%, as I say, you get 1% tax relief on your contributions, and your employer puts in 3% as well. So you basically double your money on every contribution that you make on the day that you make it. So that's a pretty good investment. Now, workplace pensions are not necessarily fantastic pensions, but that is something not to be missed. So always try to put in, if you possibly can, the minimum that you need to get the maximum your employer will put in. Then, of course, over the top of that, you might have private pensions. You might be running your own business. You might be self-employed, in which case you don't have that option of an employer contribution into your pension. And therefore, you need to make provision for yourself. Just checking on here, Glenn, have we, because I'm busy doing the presentation, have we got questions coming in?
Sorry, it's taken a while to unmute. Yes,
right.
We've had one from Joe who,
Right.
let me just find that here. Who are the best mortgage lenders? I'm guessing that's a fairly horses question.
It is very much so. There isn't a best one. There are good ones and there are bad ones. But in essence, the best one is the one that's got the right deal for you, and also has got the administration that can cope with getting you a mortgage in a timely manner. And that very much depends on your own personal circumstances. Now, I'll be clear at this point in time that although I'm qualified to advise on mortgages, I don't, and I haven't since about 1997, really. And the reason for that is very simple, that the mortgage market is very complex. There are a lot of lenders, there are a lot of products, and unless you're doing it day in, day out, you're not going to be up to speed on what's out there in the market and what's best for your clients. So since that point, I have always referred mortgage inquiries to a specialist. And we have a number of specialists within Oakwood. So that's what I've done, and they deal with that. And we deal with 50 plus lenders, and we use a lot of them because there are many different deals out there that are suitable for many different client circumstances. So it really does depend on what's the right thing for you, and that's our responsibility, is to find you the thing that's most appropriate and best advice for you. Any others, Glenda?
Yes, Pippa's got one. Okay. So women are still often at a financial advantage, for example, paying interest on student loans while on maternity leave, overcharged by mechanics, more likely to cut paid working hours to look after kids, elderly parents, etc. What can we put in place to mitigate loss of income make the most of savings, etc.
Yeah, no, you're absolutely right. There is a significant gap, and it's something that I've talked about at a number of fabulous networking meetings. There's a significant gap between the pots that men tend to retire on and women tend to retire on, and in addition to those reasons that you've mentioned there, there's the other one, that there still is a disparity between the amount that a man is paid for a job in many circumstances and the amount that a woman doing the same job would be paid for it as well. So women really are at a disadvantage, and as is the case in many other circumstances like that, it means that they have to work harder to have their finances in order, and really have got to be on top of it and on the ball, and get good advice about it. And again, you're absolutely right in saying, you know, it certainly isn't the case with me, because I haven't got a clue about cars. But you know, situations like that where, you know, ladies are taken advantage of in paying for mechanical work that didn't need to be done or whatever, you know, the stories are myriad. So, you know, I've been working, for example, with a car mechanic for 20 plus years. And it's somebody who was recommended to me by a friend and colleague. And he's looked after our cars all that time, and he's been absolutely wonderful. And, you know, you've got to find somebody that you trust, preferably on a recommendation basis. You've got to find somebody that you can trust, who you can work with over the long term, who will have your best interests at heart. And that's the same with cars and the same with finances. But there's no doubt about it, ladies have got to work harder in terms of savings and pension provision and things like that, in order to get on a par with their male counterparts, because they are at a disadvantage, no doubt about that. The one good thing in terms of the state pension provision, and you know what you think about the changes in that over the years, is another matter. But where we are now is that the state pension has been equalised in terms of when people retire, is working towards being equalised as to when people retire. Women have their pensions in their own right, and at least if they're not working because they are bringing up children, or indeed caring for elderly parents, as many do, they should be credited towards the basic state pension during that time. And it's another thing that is a very good exercise for people to go through, is to get a state pension forecast. You just go onto Google and say, what will my state pension be? It will take you through the government website. You can get a state pension forecast. It will tell you whether you're on track to get the maximum state pension, which, as I've mentioned, is about £175 a week. It will tell you what age you qualify for it at. And it will also tell you if there's any gaps in your national insurance contribution history that might need investigating. If you've worked for an employer that didn't pass on those contributions, for example, or you know, if you've just got gaps, and it will tell you whether you can make up the difference. And for people who are probably 45 onwards, I'd say that was a good thing to do. Really, for anybody who's younger than that, my advice would be, don't rely on a state pension, because I think if it is there by the time they reach that age, it will be set aside really for those people who have no other provision. So significantly means tested, and really there for people who've got nothing else. So my view would be, you know, once you get past a certain age, you know, don't rely on it. Rely on your own personal or your work provision for your retirement income. Any other questions, Glenda?
No, that's it for the time being.
Okay. So just going back to this, so yeah, you can see there the blue dotted line, that was the savings line, and by savings I mean savings in the bank, savings in the building society, savings through an ISA, savings through deposits and investments and pensions. So that savings dotted blue line now, in an ideal scenario, has turned into a line above work and private pensions, which has taken you up to somewhere around 2/3 of your final income, which is really what people should be aiming for in retirement, but is to be frank, rarely achieved, because people tend to start working towards that too late in life to actually achieve it. And it's the most that you can get if you're lucky enough to be in a final salary pension scheme, which are rarer these days than ever before. That tends to be the maximum benefit that you could get through a final salary pension scheme is 2/3 of your final salary. So that's why I've kind of put that line in there. Now, at the end of that whole process, and of course the difficulty with financial planning is we never know when that's going to be, you're going to kick the bucket. As the specials covering the pioneers said, long shot, kick the bucket. Well, the one thing in life that it really is certain is that at some point you're going to die, and your income need diminishes quite greatly then. But we don't know when that's going to be. So in addition to your work and private pensions and your state pension, which will carry on until you die, your private and work pensions potentially could run out before that point. But in addition to that, if you still own this home that we bought when we were 36 or something similar, and you've paid off the mortgage on it, there's value in that property. So you may have heard the term equity release. So that's something that you could draw on if you want to remain in your family home for whatever reason. You could draw on for additional income during that retirement period. You could even draw on it to help out your children or their children in the future if that's what you want to do. So that's again something that is becoming more in vogue these days, because there are a lot of people around who are what we call cash poor and asset rich, particularly in the area that we in the main focus on, which is sort of London and the southeast. The value of properties is quite phenomenal in a number of cases. So there's that to consider, and there's also again something that's become more and more important these days is the fact that we don't necessarily keel over and die as early as we did, but we do spend potentially a lot more time in ill health and requiring care. Be that care in the home or be that care in a care home, and that is phenomenally expensive, and therefore that's also a draw on people's income and assets in retirement as well, much more than it used to be. When the state pension used to be at 65 for men and 60 for women, as you may remember, and when it was first brought in, the average age of a person, of a man retiring at 65, the average age that they lived to was 68. I think it's now something like 86. So we're talking about much longer periods of time for people to be retired, notwithstanding the fact that the state retirement age is increasing. People are still living much longer, and that has various problems of its own. So the two key things that you've got to plan for in financial planning are not living long enough and living too long. And it's very difficult when you don't know when either of those things could happen. And therefore, as I've mentioned a couple of times throughout the course of this presentation, the thing that you need to do over and above all those savings and the other things that are happening is to put an umbrella of protection above yourself and your family to make sure that all the things that you want and plan for them for the future and for yourself for the future can still happen for them, no matter what happens to your health. And that's why every financial advisor is a protection advisor. Whether you specialize in mortgages or investments or estate planning or whatever, you should be advising your clients on protection. It's the cornerstone of financial advice. So there we go. That's me rabbiting on for about 25 minutes or something, isn't it, Glenda?
About that. Yeah, about that.
I didn't really expect it. Didn't really expect it to last that long. But the only other thing that I was going to say, this gap between the income and the savings bit, the green line and the dotted blue line, the earlier you start it, the less that gap needs to be. If you start with your saving at 18, as soon as you start your employment, and you start saving 10% of your net income, that should be enough to provide you with all those things that we've talked about. And the later you start, the bigger that 10% needs to increase by in order to fund things. So I hope that's of some use. And
it is. I don't know if anybody wants to unmute themselves and ask a question. I've been reading what's coming up in the chat. And from the interest, you mentioned the care we need in our old age. Well, that's what Laura does. Her company provides that and provides it to a very high standard, but it does cost us for that.
Yeah, please do show yourselves and ask questions and whatever.
Put the gallery view on.
I'm very happy to try and answer any I can, and any I can't, I'll take away, as they do at Prime Minister's question time, and thanks for an answer. And I really will come back with an answer.
Yeah, absolutely. Not. One of the things that I was thinking whilst people are thinking about, Laura, you've unmuted yourself. Did you want to ask a question?
Yeah, it's not on gallery view yet though, so I didn't know if you could see me. Yeah, you know, when you were just saying about paying 10% if you start at 18, but if I've heard of rule of thumb of paying in half your age into your pension as a percentage. So yeah, if I'm 34, so should I be paying in 17% of my salary into a pension and then increasing? Is that a good rule of thumb? I can't remember where I heard it or read it.
Yeah, it's a good rule of thumb for when you're starting. So
okay.
So if you're starting at age 18, and you've got your employer putting in 3%, and you're putting in 4%, and the government's putting in 1%, so you're getting 8% at that point, which is almost, getting on for half your age, but it's only costing you 4%. And that's why I say, starting early and getting in that habit is a really, really good thing.
So if you start late, then do you half your age?
Yeah,
half your age and stick with that, or half your age and then keep increasing it. So if you're 50, you're putting in 25% of your salary, if that's even possible.
If you were starting at 50, then yeah, if that was possible, then probably you'd need to do that to achieve something decent in terms. But if you've got money behind you already, if you've got money in pensions already, then it changes. And that's something you can sit down with a financial advisor and go through a cash flow modelling exercise and work it out individually for you. But just as a rule of thumb, if you don't start contributing to a pension till the age of 40, then you probably should be starting at about 20% in total.
Okay, thanks.
Thank you. Catherine's asked a question. Is it better to pay into a pension or to purchase a flat and rent it out?
Interesting. There's a feature on the Sunday Times business and money section where they interview a celebrity and ask them lots of questions about finances, and they definitely avoid telling people what they're actually earning. One of the questions is, which is better for retirement, pension or property? And I would say probably 85% of people say property. And I always look at the end of the article for their financial qualifications, and I've never seen any yet. So, yeah, I would be guided by that. Look, it's individual circumstances. There are various types of assets. There are cash, there are bonds, there are property, there are shares. And having a diversified portfolio is a great thing if you have the income to do that. As to what's right for an individual, it really does depend on their circumstances. There are pros and cons to both. Having property is great, but you've got to recognise the fact that you've got the potential for disruptive tenants, damage to the property, void periods. The tax benefits have been reduced if you're an individual investor by the government. Now, none of those things mean it's not a good idea, It's just becoming more difficult to make money from investing in property, but that doesn't mean you shouldn't do it. Investing in pensions, you've got tax relief on the pensions, that's great. At this point in time, at your highest rate, but you're investing in a pension and shares go up and down. And if we look at the markets, they certainly do go up and down. Long term, they've always produced a good result, and I expect that to continue. But again, whether investing in a pension or whether investing in property is the right thing for you to do at this particular point in time really does need individual advice about your circumstances, and to a certain extent also your feeling about it. If you're very excited about investing in property and you see that as the way you want to go, fantastic, no problem at all about that, provided you understand the pros and cons of it. If you're not and you want to go down the pension route, again, it's the same thing. Provided you understand the pros and cons while you make that decision, then that's the right thing for you. But there's no hard and fast rule.
Yeah. No, Catherine's gone on to say, if you look at how much you get monthly in London as rent versus how much you get monthly in pension once retired, I think you're better off with a rent.
Okay, well, that's not the comparison that you should be making. The comparison you should be making is how much your property is making you overall, both in terms of the rental income that you get and potentially the capital gain as well. And how much your pension pot is growing by. That's the comparison that you should make on that. And it may still be that the property is better, but that's a more accurate reflection of what you should be comparing to.
Thank you. Catherine says okay. That's helpful.
Well, I'm guessing that Catherine is keen on investing in property, and there's no problem with that at all. I've invested in property over the years. We still have a share in a property that's rented out at the moment. So what I don't like is having to spend 2 days cutting down hedges in the garden after the tenants leave before the new ones. Doesn't do my back any good at all.
No, I can believe that. Yeah, you can get good tenants and bad.
Cleaning up after them when they said they've had it deep cleaned. They've got a funny idea about what deep cleaning is. But, like I say, there's good and there's bad on both sides, and key thing is being able to make an informed decision because you know the pros and cons of both. Yeah.
Anybody else got any questions either to type in or to raise with Mike? I was just thinking about some of the things that might come up or that people might be interested in. So if a grandparent, has got a new grandchild and they think that they would like to set that child off on a good financial future, is there anything that they should particularly consider?
Maybe sure. I mean, there are various things that they can do. One of the things they can do is to put some money away for the grandchild. They can do that through various means. Give you a couple of examples. They can set up a junior ISA for the child. They can invest in the ISA. ISAs grow free of tax. Could be a cash one. Could be a stocks and shares ISA. They'll grow free of tax. But when the child reaches 16, they have some control over that, so choices about where it's being invested, etc. And when they reach 18, they have ultimate control over it at the age of 18. So some 18-year-olds are perfectly able to handle that very well. Some 18-year-olds aren't. So depending on whether they've got availability of ISA allowance themselves, they could just set up an ISA and say, well, that's for the grandchildren or the children, but I'm going to keep control over it, and I'm going to give it to them when I think they're ready, potentially when they want to deposit for first home or first car or something like that. So they keep control of it then. The other thing they can do if they really want to do something long term is to start a pension for a child. So as soon as somebody is born, they are eligible for a pension, and even if they have no income, somebody can contribute to that pension for them up to £3,600 a year gross, right through until they're earning themselves and they can take it on themselves, for example. Now, obviously, they can't get their hands on that money to a lot longer, but it does help with that discussion we were having earlier on about the earlier you start, the less you've got to pay in, because the money that's put in, money that's potentially put in during that first 18 years, could amount to half the value of the pension when they reach retirement.
Okay.
And if the grandparents are putting, if the grandparents want to put £3,600 gross into the pension, they only need to put 2,880. The other £720 will come in tax relief for that baby who's not paying any tax and won't pay any tax for many, many years. They're still eligible. They're still eligible for that tax relief.
Gosh. And the grandparents could suspend the payment, could they, if times got harder?
Yeah. I mean, pensions these days are completely flexible, so they can stop, start,
Brilliant.
put lump sums in, do what they want, really. Yeah.
Okay. Thank you.
You had a follow-up, Laura.
Yeah. Your point about well, it's about pensions. What happens to a pension if people, like, if unluckily I don't make it to pension age to actually start enjoying it? Where does it go?
Well, when you start a pension these days, you complete what's called a nomination form, and you nominate who you want the pension fund to go to if you were to die. And since 2015, you've been able to leave that money in the pension wrapper. So you've always been able to leave it free of tax, but it just back before 2015, it would just pay out. Unless it was all going to be spent that day, it's then got to be invested somewhere which potentially pays tax. Since 2015, you're able to leave it within the pension tax wrapper. So the beneficiaries, if you've died before you've started taking your pension, can access that entirely free of tax whenever they want. But if they don't, any money that they don't take at any one point is continuing to grow free of tax.
Yeah. Thanks.
Joe has also asked, when's a good age to write your will?
When's he planning on dying? Sorry, Joe, it's a very flippant answer, but who knows? My view is, as soon as you've got assets, if you've got anybody that you care about, not necessarily that you're dependent on or is dependent on you, but if you've got anybody you care about, that could be your parents, leave a will, because it makes life so much easier for the people who are looking after your assets and distributing your assets if you have got a will. So, if you go and buy your first house, if you start living with somebody and you want them to benefit and you're not married, make a will. Now, I was talking to a client the other day who's been living with somebody for 24 years. They've got 3 kids. To all intents and purposes, they're man and wife. But legally, if he dies, they're not. There is no such thing in law as a common law wife. So that's the first thing I said to him: you must make a will if you're going to be a client of mine, because it's so important. So yeah, make a will. And to be perfectly honest, if you're going to make a will, do a powers of attorney as well, because who knows when you're going to get hit by a bus and lose the capacity to make financial decisions for yourself or health and welfare decisions for yourself. So if you're going to make a will, do powers of attorney as well.
Brilliant, thank you. Anybody got any other questions? I think the last one that I'd got was sort of thinking about the times we find ourselves in now, where, the rainy day has come for many people, hasn't it? The one that people have been sorting out. Is there any way in which, if we're having to draw down on those savings that we've had hoped were going to last until we're drawing pension, is there any way in which we should start tackling those savings, from the advantage point of view?
Look, I think the first thing is, if you've got savings, it's great that you've got savings and you can use those savings, and that's a testament to the financial planning that you've done. Because one of the first things to say to clients who you want to put money away into pensions or want to put money into ISAs or this, that, or the other, is have you got an emergency fund? And it's vitally important to get some money behind you before you start doing any of these other things, because if you're contributing to a pension or to an ISA or to a savings plan, or you're paying for some life assurance, and you've got nothing in the bank and the car breaks down or the boiler blows up, you've got to pay for that, and you've got to pay for it now. And therefore, you're very likely to stop paying these other things that are long-term things in order to pay for the short-term things. And that's really bad news for your financial planning. So, before you start any of those things, put some money away for a rainy day. Have an emergency fund. Generally speaking, I advise clients to put away 3 months net income. If you're a cautious person, you might want to put away more than that. If you're self-employed, for example, you might want to put away more than that. If you're a very adventurous person, you might want to put away a bit less. But it's as a rule of thumb, about 3 months net income, and then start saving for the longer term. But if you've had to draw on those savings during this period of time, first of all, if you've been affected because of COVID, if your business has been affected because of COVID, there are a lot of support packages out there that have been outlined by the government. And look, I'm not blowing the government's trumpet. They've done things that they've had to do, etc. But they have put things in place. So do see if you can access those things, and don't in any way feel bad about accessing those things. Those things are there to help sound businesses survive an unprecedented crisis. So look and see what's available to you and draw on it if possible. We've been very lucky during the pandemic as a business, in that a lot of our business has been able to carry on over Zoom and things like that. But we have been affected by it. And there's a thing called a bounce back loan, and we're going to take advantage of that bounce back loan. And we're going to borrow £50,000, and we're going to pay it back over 6 years. It's going to be interest free for the first year, and we're going to use that to make sure that the people in our business who've been most affected by the pandemic are able to continue with their business, are able to bring their business levels back up and beyond where they were. And one of the things that we can do with that is to help us buy other businesses and take them in and provide more business for the people that we've got in the business. And that is what the government wants you to do. It wants you to keep the people that you've got in your organisation gainfully employed or self-employed, as is our case, and keep them off the books of the dole. So use those things that you can, and then once we get through this and things start to build up, build those savings back as soon as you can. But take advantage of what's there available to you to keep going through this period of time, because the vast majority of businesses are viable and were doing well before this crisis happened, and will do well again once we come out of it.
Yeah, absolutely. And one day we will come out of it.
Oh yes, all things shall pass. I don't know who said it. I just said it again.
Absolutely. You may well have answered some of this question, but Pippa put, are there any other essentials young people should sort right away in addition to pension and will?
Yeah, well, that emergency fund is the first thing, because young people tend to drive cars that break down more than other people. They tend to live in rented in accommodation with more cost-effective utilities and things like that tend to break down. So they tend to have more of those bills. I mean, I got in my car the other day and it wouldn't start, and I thought, what do I do now? Because that was a common occurrence when I was 17, 18. It doesn't happen so much 50 years or 40 years later. So they tend to have those emergencies crop up more often than people of my generation. So yes, get that emergency fund, get that starting point that says, if the car breaks down and I need a new battery or I need a new tire or whatever, I haven't got to sit and agonize about what I'm going to stop paying for to replace it. I can just do it. So that's a key tenet at that start of any financial journey is build that emergency fund.
Thank you. And then this follows on quite nicely. Joe asks, he says, banks are not a good place to put money right now. Where would you say are the top 3 places to put money?
Okay, well, first of all, banks are a good place for that emergency fund. They're also a good place for any money that you need within the next 5 years, because you shouldn't be investing in the market, the stock market, stocks and shares, which is what most pensions and investments and savings are built on, unless you can put it away and be confident that you're not going to need it for 5 years, because stock markets go up and down. I'll give you a little scenario here. On the 17th of January, the stock market was at 7674. That's the FTSE 100. On the 23rd of March, which was the day that Boris Johnson announced lockdown, it went down to 4994. So it dropped by a third, over a third. Yeah. Today, it's around the 5,900 mark, hovering just above and just below today. So the recovery has started, but it's a little bit hesitant because of that. So I've no doubt that 5 years on from the 17th of January this year, that market will be potentially above where it was, or certainly close by where it was. But if you invested your money in the middle of February this year, it's still worth quite a bit less than it was when you invested it. So you've got to have time for that recovery to take place if the markets have gone down. If the markets have gone up, fantastic. You might get a very good result over a shorter period of time, but I'm not here to advise clients to speculate in that way. So money that you can't put away for 5 years should be in the bank or the building society. Now, it might not be in the straight bank. It might be that you invest in an account where you put the money away for 1 year or 2 years or 3 years or 4 years, and therefore you get a higher rate of interest. And the easiest way to find those accounts, very straightforwardly, is if you've come across, I'm sure, a chap called Martin Lewis. If you have a look on his website, Money Savings Expert, and look at the savings on there, and it will show you the best 1 year fixed accounts, 2 year, 3 year, etc. And all of the ones on there will show you if they've got government protection. So that means up to £85,000 in each institution, not necessarily each bank, because some institutions own more than one bank, but in each institution, up to £85,000 is safe and secure. And you can put your money away for different periods of time and get a higher rate of interest. It might not be inflation over the longer term, but it will be safe and secure. So I'm just seeing there's a couple of things.
Yeah. So
yes,
Joe,
and you've mentioned, Joe, on the chat that you've put some money into national savings and income bonds, but they've been moved, and you've got to be a little bit what he would call a rate tart in those circumstances, and sort of if you're in instant access accounts, they will change on a very regular basis, and you've got to move them around. But unless you've got very substantial cash savings, the differences can be very minor on those things. And the other thing, again, unless you've got very substantial cash savings, don't worry too much about whether your money's in a cash ISA or just an ordinary account, because everybody's got £1,000 of interest that they can earn if they're a basic rate taxpayer, or 500 if they're a higher rate taxpayer, before they would pay any interest anyway. So you've got to have a substantial amount of cash before you have to worry about that.
Mm-hmm. Great. Okay. Thank you.
So yeah, it's not a very encouraging answer, but hopefully a helpful one.
Yeah, absolutely. And it's one of those times, isn't it, where we do just have to keep an eye on things, and if we possibly can, play for the long term.
Well, it is. And look, I mentioned that my wife and I, we weren't married then, but she's since cursed herself with me. But we bought our first house in 1987, and we were lucky enough to get a 100% mortgage, and actually was cheaper than both of us renting where we were renting. So, you know, it worked out really well for us. But at that time, we had a leaflet through the door, and in fact, I might still have it. Bear with me a second. I'm going to have a look in here. Yes, there we are. Look, I've had that since 1987. I'm a very sad person. Okay, so this was a national and provincial, which is the building society, which no longer exists, where we got
I
our
used
mortgage.
to have an account with them, and it was a lovely credit card with penguins on it.
Oh, right, okay. So limited to one per national provincial customer, and you could invest £9 a month, I think it was. And it was, you know, tax advantage savings. And we had bought our first home. We weren't married. We had no plans for children or anything else like that in those days. But I just thought, well, look, and we were teachers. I was a teacher. Didn't have a clue about finances really. But I just thought, well, look, it can't do any harm, can it? And we both put £9 away then, and we added to it £18 when they increased the limit, and we added to it to make it up to £27 a few years later when they increased the limit further. And when I went into financial advice, my mum got one as well. And you know, it's some money. It's, you know, 10 years, 20 years down the line, it's some money. And if you haven't put it away in the first place, you wouldn't have it. Mm. So savings is a good habit to be in.
Yeah. Give
your kids a piggy bank, and you know, get them to do something useful with it when the money comes out. It's a great habit to get into.
I think that's great advice, and I think that's a really good point to end on. Mike, thank you very much indeed for masses of information there. How can people, if people want to get some personalised advice, how do they do that with you?
Well, look, we have a service where we do a financial analysis for people, and normally we charge £500 for it, but I don't charge that to members of Fabulous Networking, or to anybody that's referred to me by a member of Fabulous Networking. It's my offer to the network as being part of the network. So if anybody wants to refer somebody to me or wants to take the opportunity to have a review, very happy to do that.
Okay, and they should get.
Might not be me personally, but somebody from Oakwood, somebody from Oakwood will do it for them.
That's fantastic. Thank you very much indeed. And what I'll do is I'll send your contact details out to everybody who's on the call, and then they can take it forward if they wish to. So thank you all very much indeed for being here, and for anybody watching on catch up. You know, if you've got questions as a result, email them to me and I'll pass them on to Mike, or email Mike directly.
And if you could encourage other people to watch this, it may be my only chance to get enough followers to be invited on Strictly.
Is that as a singer or as a dancer?
I don't think my knees are up to the dancing anymore, Linda.
Tell me about it. That's great. Thank you, Mike, very much indeed. And see you all soon. Thank you.
Take care.
All right. Bye.